two things I think if I look at our investment strategy of last year, I think a majority, our sweet spot is we go in a forward funding or a forward purchase structure. I think 40% of what we did last year was going into a development scheme, usually with a pre-lease, or it has to have a certain pre-lease, and I think that's something that we can judge very well. We did a lot of that. We did that in Munich. We did that in the US, we did it in Asia, we did it in the UK, etc. So that's something that I think is where you still have the potential to create a little value. You can also, what we've done is we've expanded our core strategy to a core plus. So we've bought something, for example, like Maximilianstraße in Munich, which had, if the pricing was steep, but we were still able to fit in, I don't know, 2, 3, 4 million of restructuring costs into that building. And we're able to take down some of the rents that our pre-owner thought he would be able to achieve, and just realistically reposition those things on the market. So in the core locations with scratches and dents, I think on the office side you can still manage to find one or two things but it's becoming a very rare and scarce product, and the added risk is already priced in the yield. So it's a challenge to really buy. On the hotel side, we simply love the business hotels, the Motel Ones, etc., the Marriott Courtyards and those kind of things. And our fund that we set up for that last year, I think we were able to commit 5 assets last year, which is quite a bit. We're presently negotiating 3 more hotels, but as I hear from the hotel boys, that the competition is heating up in that segment, Europe-wide and especially in Germany, quite drastically as well. Retail, well, we'd love to do more retail, but if anybody should happen to have a shopping center in their bag at the moment, I'd be very happy to have a look at it. It's just dried up. There's just nothing out there, which is, mainly, in my view, mainly driven by the fact that the main developers of big shopping centers, and we're talking over regional, big size, 150 million plus, they're now all building it for themselves. You look at Multi for Blackstone, you look at ECE for their own funds, you look at MFI, everybody, all the big developers are developing for their own pockets. So where's our access as an investor to that asset class now? So you get all their spin-offs with lots of dents and scratches, where future consumption will it's just a bigger risk in these things. So that's difficult. High street retail, we very much like, but it's very expensive and very hard to get hold of. And logistics, we're very fond of, but here it comes again. It's very difficult and very hard to get hold of, and it's getting kind of expensive as well. But it's just, two things have long cash flows, and with the office especially, you need to have your asset management teams there, and you need to know exactly what you're talking about, especially when you leave the big 5. And I can only suggest that you really go with a local guy who has a proven track record, and you don't overprice your cash flow moving forward. Germany does not have a tendency to grow continuously for 15 years on the rent side. It just doesn't happen, and it doesn't usually grow over your CPI index. You need to bring that rent back down when you have a releasing scenario. But that's the way we look at it, and hence why our returns are usually quite low, but in our prognosis, in our calculations, in our underwriting, but I think that makes it very realistic.